Today, the focus is on a mid-cap realty company, Ajmera Realty. If you look at the last 6 months or 3 months graph, you would see a very significant up move which has started to come in over there. And Dhawal Ajmera of management of the company is joining us today to talk more about that. Dhawal, good afternoon. Thank you so much for your time. I was reading the commentary which you've given out recently, shared with the analysts. To some, it appears a bit ambitious, 3 to 4,000 crore in revenues in the next 3 to 4 years. And you expect around 500 crore levels closing FY22 with. That's a big leap. What makes you so confident that that is a achievable kind of number going forward? What kind of steps would be required for the company to move in that direction?
Thank you. Good afternoon, Ajay. Thank you very much for inviting. Firstly, I would just like to give a brief that, as you know, that if you have seen our analyst presentation, as a company, we have divided our sales into three parts. One is ready to move in inventory. Second is new launches, which we have done. And third is the upcoming launches. So if I just give you a comparative and if I give you an analysis of all the things we have, projects which are ready to move in inventory, which have got ready. And now there is not much of cost to be incurred in that because cost is already incurred and now straight away revenue of sales is going to come. Secondly is the new launches which we have done in this FY 2021, which we did over the last quarter of this, like January to March, like the first quarter of this year. And then the new launches which we are planning to do in this year, where we are planning to launch about 4 new projects, which will have a top line of around 2,500 crores. So these are the ways where we see our revenues really rising from what we are today over the next 3 to 4 years time. So our approximately, if I go to look at the existing projects and the ready to move in inventory, where the existing projects, meaning which are going to get finished over the next 2 years time, which is already started and which will be in the range of around 1,000 crores, plus the new projects which we launched this year, which is around 500 odd crores. And the upcoming projects is 2,500 crores. So these are the few numbers which we are already in our kitty, and then plus we will have new launches coming again next year. So that is why we are, looking at a very ambitious target of the sales revenue.
Right. So that gives a visibility on what are the building blocks which will be required to achieve that kind of a number. Fair point. Talk to us about how are the cash flows of the company right now, because we also understand you're planning fresh capex of over 2,000 crore over the years. How much of that would be from the cash flows incurred internally? Would there be a need of external funding as well for this major revenue? Because it's a cash intensive business. I mean, it's a it requires rolling of money very, very smoothly. So where is that money coming from?
So obviously our primary target is to have a reduction in debt. So if you go to see, we have a debt to equity ratio earlier, which was around 1.4x, has now come to almost 1x right now in this quarter. Last year it was about 1.4x. This quarter we've reduced down and it has come to almost 1x. So what we want to do as a company is reduce debt, probably, depend more and more from our existing sales. That's what we are focusing on. And secondly is internal accrual. So obviously every project which we launch will have a finance or a debt which we'll have to take because of the premium costs and everything which we need to pay upfront. So obviously there will be debt in the project. But fundamentally, we would like to focus more on lower debts and more on our existing sales, which will run and the cash flows. And what we have experienced and what we have seen over the last 1.5 years, that sales have been in a very positive momentum and it has supported us in a better way as compared to last year and even a year before that. I mean, I'm talking pre-COVID levels. So obviously, those are the numbers where we expect the sales to support us, and that's how we will be taking our projects ahead. So definitely there will be debt depending on the project to project where it will be, but primary it will be from internal accruals and sales.
Dhaval, we are also observing high inflation is also impacting, the ingredients for in the real estate space, be it metal, steel, iron, cement. You name anything you want. What
Correct.
levels would you be able to sustain your margins, or what range or band would you essentially aim at sustaining your margins in such a volatile environment, 12 to 14 or 24 months far out?
So, Ajay, I'll just give you a small brief. If you look at, like from the time COVID started, obviously the price of the input costs has really started going up. And somewhere, if I have to compare as compared to last quarter, the input costs have increased to a very, very high margin of, 20 to 30% of our project costs have, dramatically gone. The construction costs have gone so high because the steel prices have increased, the copper prices increased, and PVC price increased. Everything increased, in a very, very drastic way. However, there has been certain prices which have also softened over the time. So what we see is, as and when, and as in how the world opens up, or the vaccinations have been done all over the world in a faster way, we will see a lot of things coming down, and that will be, that will also soften the input costs and the prices like steel, cement, petrol, transportation, and everything, which we feel it will come back to the pre-COVID levels, and that will be sustainable. So what we see is, right now, it depends on every company to company, but certain incremental cost is being absorbed by the company. But if this trend continues over the next 12 months or 14 months, definitely there will be an incremental in the price also, which we really don't want to do, but we would be forced to do because of the incremental cost, because ultimately it is going to affect the margins. So I see, certain extent there will be an absorption by the developers, and obviously with our company as well. But if the prices are not really softening, definitely there will be an incremental cost, input. I mean, the sales price would go up by around 5 to 10%,
Right. So
depending on project to project.
what band would you like your margins to be?
See, our target is, right now, currently we are at 10 to 12%. We want to increase this to 15 to 20%. And overall, if we go to see next year when we are starting our projects, our EBITDA margins for the new project, at least for the Wadala one where the lands have been old, our EBITDA margins are around at 40 levels, 40%, which I think on an average of our Bangalore projects and our Pune projects and everything, which will be around 20-25%. That's what we want to be at.
Right. And of course, you have, legacy land bank, which was much lower priced compared to many other, that the differentiation will also play out on your financial visit.
Right, sir. So as I
Right.
said, the Wadala land and all of that has been historically taken. But as we, progress further, and as we buy new lands, which we primarily do on joint development and joint venture models, which will be less capital intensive, but obviously the margins are a little tighter than what we have in our existing land banks.
We'll let you go on that one. Good luck for your projects going forward. We would be tracking it as you keep fulfilling the targets. Thanks very much for your time today.
Thank you.